Hello and welcome to Hedgeye NexGen, where we're going to continue to help you build wealth and break down finance into its simplest form. And we have Ish. He's back.
Glad to be back.
Oh my God, you left us there for a while.
I was always coming back. I missed it.
I bet you better been dreaming about it.
I was dreaming. We're coming back with a banger this time, aren't we?
I sure hope it's a banger.
Good topics.
We're going to be talking everything there is about credit cards and credit card, mostly the debt side of it. But I mean, well, we gotta go back. How was the vacation, Ish? Where were you? I mean,
California.
lay it out for us.
I was at Hedgeye Regional in LA, and I spent some time with family in the Bay Area. A little breather. I was still online, keeping up with crypto 24/7. So, but we're back in action now.
Oh man, different time zone.
Yeah. California time. Chill over there.
Yeah.
East Coast.
Fire weather. Now you're right back to the cold. Well, actually, it's getting warmer.
It's getting warmer. I came back. I mean, daylight savings makes a huge difference. So just
Oh yeah, you actually get sun at night. It's
come back and the sun sets at 7 again.
Yeah, it's 5 or 4.
Yeah, 4:30 and
4:30. Yeah, nope, that is good. All right, so let's talk about credit cards here. So I mean, I personally think they're a massive trap. Well, I'll put it up right there.
Yep.
And I would probably advocate that most people shouldn't have them.
I don't know if I disagree with you there. Yeah, that's a good one.
But basically why I think they're a big trap is, right, you have a 22% interest rate, right? So they're the highest interest rate vehicle by like a long shot, right? Your car payment's like 6-7% annual interest. House probably around 6-7% nowadays, right? And then all of a sudden you get the credit cards and it is a 22% interest rate. So what that basically means is, like, every year, like, let's say you have $100. Well, let's go even higher. Let's say you have $1,000 on a credit card. You're going to pay 22% of interest. So it's like $220.
Just like the highest interest rate out there for any kind of debt.
Yes. And the big thing with credit cards is they can start to balloon really fast on you, because you don't have to pay like the full amount. Like, there's no payment schedule, right? Like a house, there's a 30-year payment schedule. You know how much interest or how much you have to pay in order for it to
You got to pay down the principal over time. Right?
Exactly. And it's 30 years. This is how much I have to pay every single time. And then at the end of 30 years, I'm good and I'm out of my payment.
Mm-hmm.
Car payment, a 3-year car payment, right? You know how much interest you're supposed to pay. Credit cards are the exact opposite. You can basically pay however much or as little as you want.
And they'll let you keep rolling it over, right?
And infinitely.
Next month's balance, because they want that 20% interest.
They want the 20% interest. They want you to keep not paying the full amount of the credit card debt every single time. And then the also great thing is they'll give you a nice high amount of credit that you can get. Limit, like $20,000 limit.
And then you think you got all this money.
Yeah.
That's not like, you still need to come up with the $20,000 to pay it off if that's what you spend on the card.
Exactly.
And I think also, because you called it like a trap, they do come out with like some really nice intro offers, like spend $6,000 in your first 3 months, and we're going to give you all these points, and you can spend it on airlines. And then people start collecting credit cards, and that's
like Pokemon cards.
Yeah, got a whole stack of them. You can get some benefits, but if you don't manage it and you start paying that interest, it backfires quickly.
Yeah, if you don't pay it down fully, it's gonna start to hurt. It's almost like here, come over here, spend $10,000 to $20,000, and we'll give you $1,000. It's like, okay, yeah. Meanwhile, they're making like $2,000 to $3,000. Basically, always remember, banks are never going to give you free money. If they're giving you $1,000, they're probably making more than $1,000 off you. Yeah. Right? They're
I guess they make money because, the way to do it is not roll over any amount and pay off the statement balance in full. And then it's like a useful tool. But I guess they're still making money from like credit card fees with like payment processors and stuff.
Yeah.
So there's always something in it for them.
But
No free money.
yes. Yeah, definitely well, we'll get into it. But yeah, so let's start off with I have some scenarios as I typically do. So we're going to live the life of a credit card holder, and I have 9 scenarios.
I'm excited.
So let's just say you get your first credit card. Congratulations. You get $20,000 maximum on your credit card.
Wow.
I mean, way to go.
Let's spend it.
So you go out and you're like, wow, I just got $20,000 maximum and I don't have to pay the full amount of this. So I'm going to go out. I'm going to get something nice. I'm going to make a $10,000 purchase. Why not? $10,000. I mean,
Got the money.
You got the money all of a sudden, might as well go make a $10,000 purchase. And so what the credit card company is going to say is you only have to pay a minimum of $183 on your $10,000 purchase.
Wow.
Great, right?
So I get like net $9,800 there.
Right, because you can afford $183. So it looks like a great deal.
Free money.
It's not. And that's the best part. So, because here's the thing, guys, that minimum payment that they're telling you about, $183, that's just going to the interest amount. And right, there's 2 parts of any debt. It's the principal and the interest. And the only way to get rid of the debt is to pay the principal, right? That goes towards that beginning balance of $10,000. It makes it lower over time. The interest, on the other hand, that goes straight to the bank. That's the bank's money. That's them just collecting basically money off of you. Okay, so that $183 only covers the interest. So anytime you see a minimum payment on your credit card, that's the interest only, right?
So the minimum is interest. So they're saying, okay, every month you got to pay the interest, but we're fine if you don't pay any of the principal down.
Exactly.
Okay.
Exactly. And then so what happens is you just pay the interest on it, and the next month you owe $183 again. Mm-hmm. And then you can just basically owe $183 the rest of your life. And just
because you never brought down the 10,000.
Exactly.
So you're just always going to be paying that high.
That $183, which is a 22%. Just think, like, if you like 22%, like in the world, is like if you can't go out and make, I don't know, have the S&P 500 go up 22%, like that's what it is. It's literally like, think of, I need the S&P 500 to go up 22% this year, but you're just paying that to the bank. That, like, instead of you owning the asset and that going up 22%, you're just paying whatever that money is straight to the bank. So basically, yeah, that's how they get you with the minimum payment, right? Just pay the minimum payment and don't pay down the principal, and then you have infinity number of payments coming at you.
And to be clear, that's 22% paid on a monthly basis, right?
Yep.
Okay.
Yep.
So it's 183 times 12. That's 22% of your 10,000.
Yes.
And that's spend about 2,000 in a year. Just pure interest.
Yep. Exactly. Exactly. Yeah. So if it's a $10,000, it would be $2,200 in interest paid for that year to the bank.
Assuming you didn't pay down any of that.
Exactly.
Principal.
But let's get into this example, right? You have your nice $10,000 expense. But here's the thing. You have other expenses-ish, right? So the average person has about $6,200 in expenses. So you have $10,000 now. You're also put on your $6,200
per month.
Per month.
Okay.
Yep. And then let's just say you earn $8,400 a month. Now that's a little bit above the average. That's $101,000 annual salary.
Okay.
Okay. So now you have to make a payment. So let's just say this person makes a payment that's so essentially $8,300 a month, which is they only have $100 left over afterwards, right?
Okay.
On this $10,000, they're going to be paying it off for the next 5 months. But you only have $100 left over. It's insane. And in that 5 months, you're also going to pay in terms of interest $1,100.
Wow. In only 5 months.
In only 5 months, you're paying $1,000 to the bank.
And you get nothing.
And you get whatever the $10,000, which is probably for buying on a credit card. It's not like an asset that's going to go up in value.
It's just
spent. It's probably spent on like Pokemon cards or something. I mean, we'll go back to I play Yu-Gi-Oh, so maybe Yu-Gi-Oh cards. That's an old one.
Whatever you like.
Did you play Yu-Gi-Oh?
No, not Yu-Gi-Oh. A little Pokemon, but
We weren't really weird. My family would not allow us to play Pokemon, but they allowed us to play Yu-Gi-Oh. What's the difference?
It's weird that they allowed one or the other, but
what's the difference between the two? But I have a stack of a
also,
lot, and I don't know what's in the deck. I think I still have the deck, but I think we would trade with my brother. Me and my brother would trade. I think he won every single thing because he has all the shiny cards. None of mine are shiny.
Did you guys buy them on credit cards or?
Christmas was Christmas.
Okay.
I don't know what. Well, I'll ask my parents one time. Okay, let's go to the next one. So that's if you just make a $10,000 payment, okay? Or a $10,000 payment at the very beginning. Let's just say, though, you now increase that beginning payment to a $15,000 payment, okay? And you're still making the $8,000 a month, and you still have expense of $6,000 every single time, and you still have disposable income of only $100. You're going to pay off that debt in 8 months.
Okay. And when you say the payment, 15,000, like payment towards the principal on your card, or?
Yeah. So basically, $15,000 is that it? That's like you just have your first expense at $15,000.
Okay.
Because you're just like, okay, I have a credit card, I can now expect.
Oh, it's what you use the credit card
Yeah,
for.
you use it at first to buy something with 15,000, right? And then you're paying, and then basically what I'm saying is you're like the payment that you're gonna use is going to be $8,300 that month.
Okay.
So which leaves $100 in your bank account.
So of the 15, you used 8,000.
Yeah, and you pay $8,300 every single month.
Okay,
that makes sense.
In interest?
No, that's your payment. Okay, okay. All right.
Just lay it
out.
All right,
we're gonna back it up here so that everybody gets this. Okay, so you're gonna start with a $15,000. You're just gonna buy something worth $15,000
on the credit card.
On the credit card.
Got it.
Then you're gonna have monthly expenses at $6,200.
Okay.
Right? That's your food, that's maybe your car, rent. Exactly.
Okay.
Right? So now what that does is that brings what's on your credit card at that moment to $21,000. Then I'm going to say you have to pay that down. And so how you pay that down is with your earnings. Right?
So and 8,000 income.
And that's an $8,400 income. So you're going to put towards the credit card $8,300 of that. So leaving $100 for you. That's your emergency fund, is that $100.
Okay.
Right? And so what basically happens in that case is $7,900 of that is going to principal. And then it's going to be $388 in terms of interest payment. Make sense? And then at the end of that month, you're going to have a balance of $13,300.
Okay, yeah, makes sense.
And then the next month comes around, you're going to have more monthly expenses, right?
Mm-hmm. So
you're going to have $6,200 in monthly expenses. You're going to get your same salary.
Yep. And
you're going to put the same $8,300 to pay it off, right? And then at the end of that, your total balance. So now your total balance, 357 of that goes to interest, and 8,000 of that goes to paying off the principal. Now your ending balance on the credit card is 11,500.
Okay.
Right?
So you're bringing it down.
Yeah.
Each month. You're
bringing it down each month because you're paying over the minimum.
Yeah.
Right? If you only paid the minimum interest, which would be $388, you would never pay down the credit card. Right? Right. You have to pay above that minimum in order to pay down the credit card over time.
Okay.
Okay?
Got it.
All right. That was good. Now everybody gets this.
We're on the same page.
We're all on the same page. All right. So what would happen is, in this case, this person would be out of debt in 8 months.
Okay.
So for 8 months, they're basically living off $100.
I guess that's their that's their
That's
savings, basically.
their savings or emergency fund is $100
Okay.
for the next 8 months due to this situation that they're in.
But all their expenses are covered, though, right?
All the expenses are covered, but we'll get to what if in case something happens.
Yeah, you're not. You're prepared for anything out of the ordinary up to $100, right?
Exactly.
Okay.
Which is
Not gonna.
it's not gonna fly. And in that case, over those 8 months, they paid a total of $2,200 in interest to the bank. So that's just money that's not theirs anymore or yours anymore, and it's just it owns the bank.
The cost of living the way they did. Basically.
Exactly. Okay. It's the cost of making that first purchase is really what it is. And so we'll go to a little bit more of a slightly realistic situation. Is they have now let's just say instead, or they make a $10,000 purchase to begin with.
Mm-hmm.
Okay. They're still going to pay annually 22%.
Okay.
Okay. They're still going to have the earnings of $8,400.
Yep.
Expenses of $6,200. But instead of having $100 left over every month, they're going to leave $1,000.
Okay.
Right. So that basically means that at the end of every month, you save $1,000 in your account for an emergency to happen or not happen.
Yeah.
Okay. So what that means is, if we go to this, is so basically your first payment, your credit card's gonna have a total of $16,000 on it, right? You pay $7,400 to it, right? You're gonna pay $300 in interest and $7,000 in principal. Your ending loan balance is gonna be $9,000. Okay, and you just keep doing this, and eventually you're out of debt now at the 10-month mark.
It's longer than the other one, right?
Exactly.
And that's because you kept more.
That's because you kept
in the emergency.
more money in the emergency fund. So just compare that to our first example. You were out of debt within 5 months.
Okay.
And you only paid $1,100 in terms of interest. Now you're out of debt in 10 months.
Mm-hmm.
And
total interest
you paid $2,100. So you basically doubled the amount of interest and you doubled the amount of months that you were paying it.
But trade-off is you had a little bit of extra security for like anything unexpected.
Anything unexpected. Okay. Exactly.
Yeah.
But it's still like you are just paying the bank just to make a nice one-time purchase,
right,
whatever that $10,000 goes to, and that's the thing that you really paid $12,000 for whatever you paid for. So not only are you paying above the market, 22% above the market of what those Yu-Gi-Oh cards, right?
Your Pokemon cards.
Pokemon cards. All right. You're paying 22% above the market on your Pokemon cards.
Yeah.
And guess what? Your Pokemon cards aren't going up in value. So guess what? you're just paying 22% above what you could have gotten it for basically you just wanted it.
There's no reason. Yeah.
And this is how people though get into a rolling credit card issue.
Now, I mean, realistically, like if anyone they really wanted those Yu-Gi-Oh cards or something, and they know they're not going to be able to pay it for 5 months, 10 months, they shouldn't be using a credit card for that purpose.
Right.
Yeah. Because the credit card, its offering is it's a 30-day loan. No more than that.
Exactly.
If it's more than that, suddenly you're paying 20%, which is the worst interest rate possible.
Exactly. It really, you kind of can't afford the Pokemon cards until 5 months goes by, and you can then afford it. Yeah. It's really what it is.
Unless, if you really need it, like, I don't know, find like a personal loan somewhere. Not that that's much better, but lesser interest rate if you can, like, you have a good credit score, buy your Yu-Gi-Oh cards on a personal loan or something, as opposed to
what personal loans you getting out there?
Yeah, like you.
I want to know.
You get a personal loan if you tell them what it's for. It's at Yu-Gi-Oh cards.
You're not getting a loan.
But credit card is the worst way to do it, but they'll let you do it. They won't ask.
Yeah, credit card, that's the thing. They do not ask what you're buying it on. They do not care. The bank just wants you hooked, and they want that 22% every single year.
Yeah.
And they make a boatload off of those fees.
It just becomes like a downward spiral.
Yes, exactly.
Because let's say you do get hit with one of those unexpected.
Oh, we're gonna get there.
Okay.
Well, let's the next couple of next ones will really get into this. So okay, so let's go to our next example. Example number 4. Okay, we're gonna say that you had a beginning balance, and we're gonna make it a little bit more realistic.
Okay.
You went out and you only bought $5,000 worth of Pokemon cards.
Yeah, realistic.
Okay. So $5,000 is your first time purchase. It could literally be a couch. You go and you buy a couch for $5,000. Probably more people will relate to that.
Yeah.
Okay. Then you have earnings though of $5,000. Okay. And so that puts your annual earnings to a $60,000 salary, which is right around the national average.
Yeah. That's
okay. Realistic. We're going to bring down your expenses to $4,000. Okay.
So modest apartment somewhere.
Exactly. An apartment, you're not really going out all the time, but you go out once a month or so. I mean, sure. Decently realistic on the expenses side. Okay. And we're going to allow this person to have $500 at the end of the month. Okay. Mm-hmm. So let's start this off. So just $5,000 couch.
Yep.
Okay. That's on the credit card. You're going to have $4,000 in expenses. So that puts your total to $9,000 on the credit card at the end of the month.
Okay.
Okay. You're going to have to pay a minimum $165, which we're going to say do not pay that minimum, because if you do, you'll just have debt your entire life.
Right.
They're going to put towards it $4,500.
Okay.
Right. So $165 goes to the interest. $4,300 goes to the principal.
Right.
Okay. And so at the end of the month, they're going to have an ending balance of $4,600, okay, from $5,000.
And they got $500 in savings, right?
500, yes, and they still have $500 savings. So what happens is next month comes around, your $4,700 in terms of the balance left over. You have to add in your expenses of $4,000. Now you're at the end of the month. The next month, month number 2, $8,600, right? And you're going to put another payment of $4,500 down, right? And so on and so on. So every month you're just repeating that process.
Yep.
You're going to be repeating that process for the next 13 months. Okay.
That's a long
13 months. This is how you're just going to be living your life. It's true though.
Like is that $5,000?
That $5,000 couch.
Yeah.
Okay. Yeah. Right. And over that time, you're going to pay $1,600
interest.
In interest.
Okay.
Yes. But as Ish was mentioning, you're going to have different expenses. This is 13 months that you're paying. You're going to have.
I mean, the odds of something
not
up or
exactly. Yeah. Like something's going to come up. So we'll go to me. I have some really bald tires. So I'm going to get some new tires within this 13 months because I really need them. Okay. So now we go to this person. They're going to keep paying the same way. But in month number 10, they're going to spend, let's see how much on new tires. $1,500 on new tires. I think that's how much tires cost.
Yeah.
That's how much mine costs.
You're getting some good snow tires or something. I don't
know. I think that's just how much tires cost.
Yeah.
Well, $1,500 for new tires or car maintenance. You pick it. I was
something with your car.
Dude, I'm leaking oil. I'm leaking antifreeze. I also have no tires. My car is dying.
That's going to cost you $1,500.
Oh no, that would cost $10,000-ish.
$10,000.
They want to charge me $10,000 for all 3 of those.
I mean, get a new car. I don't know.
No, maybe
a used car or something.
Yeah. Yeah, but then I can't sell this car because it's leaking all over the place and you're not ready to blow up. But anyway, it's okay. It's okay. All right. So on month 10, we are getting new tires. Okay. So all of a sudden now you're in this debt situation for now 15 months.
So that $1,500 expense, my question is, in your scenario, are you adding it to the credit card balance.
Yeah.
Could you, because you've also been accumulating 500.
No, you're not accumulating it. You're every month you're just having $500.
Oh, that just stays flat the whole time.
Yeah, exactly.
Oh my
Yeah,
God.
you're not accumulating 500.
What was the monthly income in this scenario?
Your monthly
5,000.
income is 5,000.
Okay. And then the monthly payment towards the card was 4,500.
4,500. Yep.
Okay. Got it.
Yep. So in month 10, this happens all the time. You gotta buy new tires. So now instead of from the previous example, you were out of debt in 13 months. Now you're gonna be out of debt in 15 months. So 2 extra months for the tires, right? And you're gonna increase the amount of interest you're paying to $2,100, up from about $1,600. So like $400 to $500 extra dollars in interest for these next 2 months. But what you might have noticed here is 15 months. We got Christmas coming up.
Yeah, I mean, you're within the 12 months.
You're within 12 months. You're gonna have to pay for Christmas.
Another unexpected.
Yep,
Right.
another unexpected purchase. And what we're gonna say is we'll keep the same situation. You got your new tires in month 10, and you got Christmas in month 12.
All right, how much we spend?
Well, we're gonna put $2,000 on the credit card for Christmas.
A lot of gifts to give.
You got a lot of gifts. You got maybe a couple kids. You got some aunts, uncles, significant others. I mean, I didn't even put birthdays in here, but no, it's okay. Well, let's take the Christmas. Let's take the Christmas. $2,000 on month 12. Now, all of a sudden, the amount of times, how long you're in debt is now up to 22 months.
That just got a lot longer.
It's got a lot longer. So you just went from, in the previous example where you just had new tires, to 15 months in debt. Now you're at 22 months in debt. And you have cumulative interest of $2,800.
Okay. And now we're at 22 months.
Yep.
Just under 2 years.
Just under 2 years.
Bound to be another unexpected.
Yes, there is absolutely going to be an unexpected event going to happen. Do you know the number one reason for personal bankruptcy?
No.
It's medical debt.
Oh, really?
Medical debts put people into bankruptcy.
Yeah, something could happen to you. Like, you get hurt. I mean, it could be like a car crash, or maybe you do some kind of sport and you need, I don't know, physical therapy, or something happens.
Broken arm, whatever. But as you can probably start to think, right, if you're already paying 22 months, which is almost 2 years.
Yeah. Just shy of 2 years.
Just shy of 2 years, right? If you add any more expenses to this, like, you're in trouble.
Yeah.
So that's what number one cause bankruptcy is a medical event. So we're going to have a medical event. We're unfortunately going to be in the hospital for now 2 days.
Just 2 days.
2 days. Whew. We're going to put the medical expense to $5,000. And that's going to happen. You got your new tires, month 10, Christmas month 12, month 17 rolls around, $5,000 in a medical expense. Maybe I was snowboarding. I did this. I was snowboarding, and I was like, you know what? There's only one way to learn how to snowboard. I skied my whole life. And that's to go to the top of the mountain. If I make it down, I know how to snowboard. If I don't, never snowboard again. Well, broke my wrist.
Big medical expense, huh?
Oh my God, what an idiot. We literally tried. I can't snowboard. And that was a fun. So now $5,000. You are now in debt for a total of 38 months.
Just keeps going.
38 months.
This scenario is giving me anxiety, to be honest.
Oh, it only gets better. 38 months. So that is an extra. That one medical expense just set you back 16 months. And now in terms of interest, you have now paid $5,600 in interest.
In total. And
that's money not going to your pocket. That's just going straight to the bank. And they just made $5,600 off you.
And this interest is all on the card.
Yeah.
Because of that initial purchase.
The initial purchase of the $5,000 couch. And it's just going to keep snowballing-ish.
Because you could have been paying your monthly expenses with your income, not on credit card.
Exactly. you save up for the couch, and then you can buy the couch.
But instead, you decide to jump the gun, buy the couch, and then you get stuck paying the interest along the way.
Exactly.
That just keeps adding up.
And it keeps adding up. And if any small thing happens, all of a sudden, you're now paying more and more interest, which is about what's going to happen. So I don't know if you noticed this, but 38 months, we've only paid one car expense in month 10. Yeah, you have oil. You got to pay for your oil bill, and maybe something else happens. So we'll put a $200 every 10 months on this because for random car expenses.
Yeah, gotta.
So because oil is basically $100, and we'll put an extra 100 for who knows what. But I don't know if you noticed, but 38 months, that's another Christmas.
Yeah, I mean, it's just the years are adding up.
Yep. So month 10, you get new tires, and then it snowballs into month 12. You got Christmas coming up. Month 17, unfortunately, you had a medical event happen. Now you're at month 20. We have to add $200 for, we'll just call it oil. Month 24, another $2,000 for Christmas number 2. And you're going to be out of debt in 45 months.
Okay. So I don't know if you can, in the scenario here, the second Christmas, it added what, 7 months? Is that right?
Second Christmas added.
So I think you said it was like 38.
Yeah, I got this. And second Christmas added. We got this.
What I want to see is, did the first Christmas and
7 months added 7 months?
Okay. What did the first Christmas also add 7, or was it less than?
No, it keeps adding 7.
Okay. Because I was wondering, like, if you have the same expense further down in your like credit card debt timeline, does it add more? Does it keep you stuck for longer?
It just keeps pushing the dates out further and further, and then you just have to keep going.
Yeah.
And so in this example, you have your second Christmas, you got your oil change, you're now out of debt in 45 months ish. 45 months.
Almost 4 years.
Yes, almost 4 years. That's cumulative interest of $7,000.
Now you've paid more than double the couch's value in total when you include interest.
Yes.
Yeah.
Yes. And you know what actually basically happened is we added that, but really we have to add more Christmases.
I mean, you gotta add so much other stuff. Birthdays, something happens to your house. I don't know.
So
vacation.
Yep.
Didn't even mention that.
No vacations are allowed in this.
Vacations
for
4 years.
For the last 45 months, you have no vacations or allowed.
And you still paid $7,000 in interest. It's like, wait till you include the rest of life in there.
Yeah, and really, here's the thing. We're actually missing a Christmas, so we have to actually add that in. Okay, so now, you have to add another $2,000, and when we add that, guess what's also going to happen? We're going to have to add another two $200 payments for the car.
Yep, oil.
Okay, because it just keeps getting put on top, and then that's going to bring us to about month 50. Which also means we got to add another Christmas-ish.
Oh,
we're now at 4 Christmases, I believe. 4.
Yep.
And now, once you have this, I'll read it out loud. You got your $5,000 couch to start you off. Then you get your new tires in month 10. Month 12, you got $2,000 Christmas. Unfortunately, in month 17, you got medical expense of $5,000. Month 20, you're going to have a $200 car expense. Month 24, another $2,000 for your second Christmas. Then you have a month 30, another $200 for your car expense. Month 36, your third Christmas for $2,000. And then month 40, you have another $200, right? You're still in debt this whole time.
Please.
Christmas for your fourth time on month 48, you're going to have another $200 for month 50 in terms of your car expense. And then finally, we're now at month 60, is when you would have been out of debt, but month 60,
5 years.
you know what month 60 is?
Another Christmas.
That's a Christmas. That's a Christmas. Once you're now one.
Endless.
You're 1, 2, 3, 4, 5 Christmases now. And finally, you now have to pay off your $2,000 Christmas. That brings you to month 64, where you're now officially out of credit card debt.
Wow. Okay.
And you, that whole time,
so it did end.
It does end. It does end right there at month 64. So 5 years later, 5 years and 3 months later, it ends. And the entire time that you were in debt, you paid a total of interest of $9,718.
In total, you could have bought 3 couches if you include what you paid for the couch and the interest you paid on the couch. Could have had 3 couches, basically. Like, that's what the cost of your one couch was.
Yes, exactly. And let's just say, I don't know, inflation happens and expenses start going up. You got to push that 64 months out even more. And it all starts to balloon on you real quick.
So as soon as you enter credit card debt, you suddenly are on thin ice for the rest of the time. Basically.
You are on extremely thin ice until it's all paid off.
Yeah.
Right? So I don't think anybody, because this is a lot, like you should never go into credit card debt. I personally say because you don't want to put yourself on thin ice, one. And the second part of it is like just, yeah, you just don't.
And you know what's interesting? 0 investments or assets were included in this at all.
Yeah, you can't make investments.
Room for them. Yeah.
You can't make an investment.
So, I mean, you just walk away with nothing.
Yeah.
Nothing.
Yeah, and you walk away with the couch, and this is 5 years later. Life events are going to happen in 5 years. You might have another kid. You might get married.
You get laid off.
You can get laid off. Anything can happen.
Mm-hmm.
And it just keeps snowballing on you.
Yeah. It's like the longer you're stuck in it, the more vulnerable you become to more and more unexpected events. Thinner ice.
Exactly.
I think like the moral of the story here is credit card debt is only for something that you can afford within the 30-day period.
Exactly.
Because you cannot bring this over into interest. You don't want to roll it over or you end up in this scenario.
Exactly.
So only use it for something that is affordable to you within 30 days. Probably a small purchase, not a $5,000 couch.
Yep.
And at that point, if you can pay it off in 30 days, I mean, you also might be able to just pay it off without debt because that's a short period of time. Like maybe you could just save up and
exactly. Well, pretty much.
Yeah.
Like think of it as like a debit card.
Yeah.
Right?
Exactly.
Right? Like
spend what you know you have.
Exactly. Well, that's why like almost say like debit card's very easy to understand, right? Like whatever's on the debit card, you can't go negative, right? Mm-hmm. So you just spend what you have, and whatever you have, it's what you have. There is no extra coming.
That is exactly how you should think about it.
Debit card,
yeah,
or cash is really what it is, right? And so that's why I'm like hesitant for people even having a credit card because they slip,
right?
But yeah, think of it as a debit card.
I guess, you know, someone might ask, okay, well, why even use a credit card if I got to think of it as a debit card? Well, there are benefits, which are your credit score, because you will probably need to, you know, use that credit score to get a loan at some point in life, a mortgage, student loan, or something. And you can get like points and stuff, which do benefit you. So that's the benefit of using a credit card wisely. You actually can get something out of it.
Yeah. I think the biggest problem is people just don't use it wisely.
They don't use it wisely because it's much more complicated than the simple debit card. You got the interest, principal, statement balance, minimum payment.
Yep.
A lot of things going on there.
Exactly.
If you're not financially literate at all, that's the trap.
It balloons.
Yeah.
It balloons, and one expense sets you back for the rest of your life.
Yeah.
And it's dangerous. I mean, too though, like you can build credit without it. Like, I think credit scores are a scam if you really think about it, right? The person with the best credit is the person that's in credit card debt. That's basically how a credit score works.
Yeah.
And what are they paying for that? Well, in our example, over 64 months, they'll pay a total of $10,000. So is a better credit score really going to be worth over $10,000 within 64 months?
But you could have a good credit score
No.
even if you don't pay interest, as long as you
Yeah.
meet your payments.
Yeah. Exactly. Right.
That is the credit system.
And then points are just spend $10,000, get $1,000. So
You don't get a lot of points, but you get some benefits. Yeah,
yeah, it's
it's a bit of a trap.
it's a trap.
Trap.
I think it's a big trap.
It reminds me a lot of this game. I just searched it up. I found it surprisingly. It's called playspent.org.
Okay.
And
Okay.
it basically puts you through this simulation where you're kind of like living paycheck to paycheck, and these unexpected events come up like health emergency, and it's just kind of like we're doing. It'll track your income and savings over time. So everyone check that out. Not a
That's
plug.
cool.
I didn't make it, but it just came to mind.
Yeah, I mean, yeah. Well, also, it's like you never know what life event's about to hit you, right? Like, dude, girlfriends, expensive, man. You gotta take them out to dinner. We got to feed them. We got to take them out to dinner.
Yeah,
like,
that's
I
up.
mean,
That's up.
out to dinner because now you're not just paying for one person. You got to pay for them too. Sure, you're a good guy out there, right? That could be $100.
Yeah.
Right, and you have to take. They want to see you a bunch, right? So all of a sudden, that's four times.
It's an ongoing expense if you want to keep them.
Yeah, and then all of a sudden they're gonna want to get married.
All of a sudden.
All of a sudden, it'll sneak up on you, and then they want to get married, and then you're like, oh, I gotta get a ring.
You gotta get a wedding. Oh no.
Guess how much a wedding ring is? Between 10 to 30. I mean, like it's unlimited, but like
it could be unlimited.
you're talking about $10,000 to $15,000 expense. You know what comes right after that wedding ring expense? The wedding itself.
Wedding.
You know how much those cost?
No, I don't know.
Oh my gosh, you're talking like $50,000 to $100,000. I mean, probably on the $100,000 end.
And imagine like let's say like you're already in debt because you like bought the couch and you're paying interest, and then like your girlfriend proposes to you. It's like,
wait, the girlfriend's proposing to you, or you're proposing
sorry,
to
you're
the
proposing to
girlfriend?
girlfriend. Egalitarian.
You know what? You're right.
You propose to the girlfriend. Okay, the girl's in debt. Let's say you're the girl, because I want it to be like you're in debt and something that you didn't plan happens to you. So
okay. So we'll be a girl.
I'm a girl.
Okay.
The girl is in debt, and my boyfriend proposes to me.
Yeah.
I'm not gonna say no. I'm in debt right now. Like I don't want to. Well, I guess he's probably gonna pay for most like the wedding ring, anyways. But
yeah, he pays the 10,000.
The wedding.
The wedding. Yeah. You got it. There it is.
So that just adds to the debt spiral. So
that's 80 to 100,000.
Yeah.
And you know what comes after the wedding?
What's that?
The honeymoon. You got to go on a nice little honeymoon there.
Somewhere.
You know how much that's gonna cost you?
I don't want to know.
$10,000 to $20,000. All of a sudden, you got 20,000. Let's call it $15,000 on a honeymoon. Okay, the wedding ring. Let's do another 15,000. So that's $30,000, and let's do a $700,000 or $70,000 wedding. So what does that put us to? $100,000? Yeah. So $100,000 all of a sudden, and and you're in credit card debt. The math don't be math.
No.
Because you can't save up for any of that if you have a credit card debt. You can't save up for that. That's it, like if you have a car debt too. Like you cannot save as long as you're paying the bank interest.
Yeah, as soon as you entered the debt and didn't pay off that monthly balance, for as long as you remain that way, you're just in a very dangerous position.
Yeah. It's literally like walking on thin ice, and then at any moment you can fall through. And that is why medical expenses are the number one cause of debt, because everybody's walking on thin ice.
Yeah, because everyone could be susceptible to that.
Most people are walking on thin ice, so that's why a medical expense puts people into bankruptcy, because nobody's planning for it.
But you know what? The math does math for the bank.
It always
It always works for that.
The math be mathing for the bank, yeah. They're making 22% a year off you. Imagine getting to S&P 500, right? And you can just lock in 22% every single year. I'll take that.
Yeah.
I think it's nice 22% every year.
That's great.
Woo.
That's what they're doing.
Yeah, it's exactly what they're doing. crazy.
So you need to reverse the roles.
Exactly.
Not that they're going to go into debt for you.
The only way you reverse it is by never having debt.
Never interacting with that system.
Right.
Basically.
You never have debt, and then you're just investing your money elsewhere.
Yeah.
Pick your investment, whether it's a stock, bond, house,
and I think
whatever.
We've done other episodes on that, like what those scenarios end up looking like if you put this much money from your paycheck into this asset, and what returns would look like.
Yep. So, did I calm your anxiety with that spiral?
No. I'm gonna be very cautious with my credit card. I'm thinking about this today.
Yeah.
But don't roll over.
Don't roll over.
Number one lesson.
Hey, this is not a fire drill. You're not rolling over.
No. Worst interest rate out there.
Yeah.
It's not meant to be paid.
Yeah.
For the bank, it is. But for you, like, you shouldn't think of that as an option.
Yeah, exactly. It is not an option.
Yeah.
It is not an option. Do not do it. Run. Any questions here on this?
I think that's all I got. I'll probably play the Spence game to really feel it out. What this?
I'm kind of interested in this. This looks cool.
Paycheck to paycheck. It's how a lot of people live, unfortunately.
Yeah. Well, and the reason why they're paycheck to paycheck is they bought that $5,000 couch, right?
Yeah.
And so at the end of the month, they only have $50, right? And so that's why they become the paycheck to paycheck, because it's literally, they cannot spend any more. It's all going towards the debt or whatever, right? And so
I guess you gotta live below your means.
And the only way to get away from that is you live below your means, you cancel out the debt, and then you just utilize your income as best as possible. That's your best tool, and lower the amount of expenses. And the best way to lower the expenses at first is get rid of the debt. And then you can look at elsewhere.
Yeah.
And there we go.
How to build wealth 101.
There we go. I think next time, I promised some guy, he wanted us to, he actually messaged me on the Twitters. We have a lot of people listening to us, Ish.
That's great.
Yeah, I know. So
thanks for listening.
Yeah, absolutely. Thank you for listening. So he wanted us to go into insurance. So we're going to go into insurance the next time. I think whole life versus term life. We're going to learn about it and we're going to figure it out.
It's a deep one.
Yeah, deep rabbit holes. Only here in NexGen. But yeah, thank you everybody for joining and watching us, supporting us. You can follow us on the Twitters. You can also listen to us anywhere they have podcasts. You just look up Hedgeye Podcast, and we are Hedgeye NexGen under that. Apple, Spotify, HedgeyeTV.com. And that's it. We're out. Thank you, everybody. See you next time.